My name is Jake. Welcome to the channel. It's 2022. We're in our first month here into the year, and your portfolio is down over 50%. A year ago, you thought everything was working out. You knew better than everybody else. Your portfolio was at all-time highs. What could go wrong? We're now into the new year, and your net worth is cut in half. And you're thinking to yourself, what the heck is going on? Why is my portfolio so down? I thought that these were great companies. What's happening? And now you're reconsidering all of your life choices and you stumble upon the beautiful concept of dividend growth investing. And you clicked on this video because you want to learn how to research dividend growth stocks. Well, my friend, you're not alone. There's tons of us out there that have gone through, what you're going through right now. If you're seeing your portfolio down 50%, understand that it's quite normal. I'm sure there's a ton of people out there that are in the same boat as you and just asking the question, why? Why is this happening? What is going on? How could this be happening to me? I'm a good person. Why is my portfolio down so much? Well, in this video, I want to talk with all of you and share with all of you how you can research dividend growth stocks if you're considering building out a dividend portfolio here in 2022 and really focus on quality when building out your dividend portfolio. So in today's video, I'm going to share with you how you can use a tool or a website like Seeking Alpha to do all of your research when it comes to researching dividend stocks. Okay, that's what we're going to talk about in today's video. So if you go to other websites and you try to find dividend information, what I've noticed is, which can be pretty dang frustrating, is you'll go to a website like dividend.com and you'll go and you'll find their screener and you'll be like, yes, finally, I found a great website that I can research stocks on. And you're like, oh, why is this blurred? Why can't I see the information? And then you click on it and they're like, bam. Pay for my service and then we'll show you the information. And you're just like, no, I just want to look and do my own research. I don't want to have to pay. And you go and you look at their other filter and you're like, what does this little premium button mean? Oh, it means that I have to pay, so I can't use your website unless I pay you? That's not very cool. And even on seekingalpha.com, what we're going to go through it here in this video, but even if you go on their website and you see, okay, they have a lot of great information, and you're like, oh, top stocks, that's great. Top rated dividend stocks, great, let's click on that. And you're like, wait, what's that? Results, okay, there's 33. What does that mean? Oh, I have to start a trial. Oh, I have to pay something. It's like when I see this 33, it's like this hidden number that I can't see. It's like there's 33 singles in my area that want to meet me. And it really makes me feel like this. I feel like I'm getting bamboozled. And so I can't see the 33 dividend stocks or singles in my area unless I pay. And so that's what it kind of feels like when I look at some of these websites and I have to pay. So we're going to avoid all of that. I'm going to show you how you can research dividend stocks without having to pay a single dime. So if you're a brand new dividend investor and you're trying to find all the great information on dividend investing and you run into this pay to play kind of model where you have to subscribe to get the content, you're probably feeling a little like this.
Okay, Wi-Fi plus 3G, 64 gig. This one.
Oh, sweetie, $900? Eric, we can't afford that one.
Well, you don't expect me to get the Wi-Fi only 16 gig version, do you?
I think we need to get you a different brand, hon. They're a little cheaper. Here, look at this one. Toshiba Handybook.
Toshiba Handybook?
Oh my gosh, Toshiba Handybook. Oh man, good times. All right, so before we dive into Seeking Alpha and we take a look at individual stocks, I want to help all of you with that step before that. So if you want to find a dividend screener, or if you want to screen for dividend stocks based off of specific metrics like their dividend growth, their yield, etc., there's a few good websites out there that are free that you don't have to pay for. Okay, let me walk through a few options that you have. The first option is through MarketBeat. I will leave a link to this website below. I'm not affiliated with any of the companies. I just am a do-it-yourself investor like all of you and just trying to help out the little guy. So this website it's fine. I've seen some inconsistencies in some of the metrics in some cases, so always double check. This website's kind of annoying because every 30 seconds you'll get a pop-up ad, but it's free. The second website here that I would recommend, this is probably my favorite source when it comes to dividend research. The website here, Sure Dividend, it's not a flashy website. It is really a best of breed when it comes to actual dividend information. They do have a paid service with a newsletter. I don't pay for their newsletter. I just use their free services. And I think the content that they provide for free is fabulous. It's absolutely amazing. So you have all of the lists here with, for example, the Dividend Aristocrats, and these are updated. Like they update them almost monthly. So this is really up-to-date information. The Dividend Kings, all of the stuff that you want. And here, this is great. They publish all of their articles, and you can read up on, specific companies if you're interested in them. And they have a lot of great content. And if you do download their list, you have to enter in your email. But what they'll do is they'll send you over a file, an Excel file of all of the Dividend Aristocrats, for example, and you'll be able to filter based off of the things here up at the top. You can filter by dividend yield. You can filter by how many years they've increased, right? You can filter by the dividend growth, the PE ratio, the payout ratio, the beta, and then they have other things here. You can filter by performance, all of this great information, and it's all free. So I would highly recommend if you're looking to do research on Dividend Aristocrats or you want to screen for dividend growth, this is by far my favorite way to screen for dividend stocks. The third way that you can do this is you can go to ETF.com and you can type in, dividend ETFs like Noble, and then you can scroll down here and you can see the different holdings that are in these ETFs, and you can see, okay, this is a good starting point to find out which companies you want to even, first learn about, right? Before you're even deciding to research individual stocks, you want to maybe make a short list of companies that you do want to research. You could also look at an ETF like SCHD. This is one of my favorite dividend growth ETFs out there. And you can see, the top weighted stocks, dividend stocks in an ETF like SCHD. It's a great way to start to find the dividend stocks that you do want to research, which you can then go on a website like Seeking Alpha and then research on there. Okay, Seeking Alpha has an amazing amount of content and information around dividend investing, stock investing, ETFs, everything under the sun. This website offers so much. It's kind of like a YouTube, like a written version of YouTube, where there's so much great content and articles from, the community, some being very well known, some being maybe newer, but there's so much content out here. And I think it's important that, you don't get overwhelmed. If you're a new investor, really focus on the basics and the fundamentals of the things that are important when it comes to dividend investing. So we're going to touch on a few things, and I'm going to walk you through how I personally, on a daily basis, whenever I'm researching a stock, some of the things that I look for when using a website like Seeking Alpha. Something that I like to do is you can actually upload your portfolio in Seeking Alpha, and you can monitor your portfolio this way. So it's just monitoring the individual stocks. It's not like a dividend tracker. So you're not going to input how many shares you have. All it does is it shares data and insight on the companies that you're invested in, and you can get very granular. Which companies in my portfolio have the highest dividend growth? Which companies in my portfolio have the longest standing, consecutive years of dividend growth? You can take a look at the valuation. You can look at the forward PE. Which companies are the most expensive? Which companies are the least expensive based off of their price to earnings? All of those things you can do at a bird's eye view over your portfolio. This is something that I use quite often. When it comes to screeners, they don't have an individual stock screener, but they do have an ETF screener. The ETF screener here, it's right, where is it? The ETF screener right here. So the ETF screener, this is really great if you want to screen for ETFs, but they don't have one for stocks. Okay, but first what we're going to do is we're going to walk through and we're going to look at a few different companies, and I'm going to walk you through some of the things that I do as a dividend investor and some of the things that I'm looking for. Okay, so you may want to pause the video throughout, as I'm explaining this. You may want to rewind it, a couple of seconds if you didn't understand something. Really my videos here are centered around new investors. So I want to say, if you don't understand everything that I'm saying, it's okay, right? We've all been there. This is really just an introduction in how I personally analyze and review dividend stocks. Let's take a look at Pepsi. Pepsi, everybody knows what Pepsi is, right? You got Lay's chips, you got your Pepsi Cola drinks, you got your Mountain Dew. Mountain Dew's my personal favorite. Like there's so many great products that Pepsi has. And what we want to take a look at is, if you're a new dividend investor, you're probably going to go and you're going to click on this first. You're going to click on dividends. All right. And then you're going to scroll down here and you're going to see the dividend summary. You can see the dividends that they've been paying out. So for example, for every share of Pepsi that you own, you got paid $4.30. We're going to talk about what the payout ratio is and all of that stuff. So if you're a new investor, you're probably going over here and you're first taking a look at the dividend section. Okay, let's start with the dividend yield. Let's start right here. So if we look at this, there's a couple of things that I like to look at when I'm analyzing dividend stocks. First, I like looking at this, the 4-year average dividend yield. So if you were to dollar cost average into your portfolio, what is the realistic yield, the dividend yield that you would be receiving with the dollars that you're investing on an average, regular basis? You would expect reasonably to receive just right around a 3% dividend yield. So if you dollar cost average into Pepsi over the last 4 years, this is the dividend yield, the cumulative dividend yield that you would expect off of your investments. Okay. And the thing that I like looking at here is, okay, relative to where it's trading today, what is the starting dividend yield? Is this a fair value? Is it not fairly valued? If you look at this, Pepsi is yielding just under 2.5%. So it's yielding lower than its 4-year average. So it's trading at a pretty high premium. This is not something that I personally would want to, lump sum invest into right now at these levels. If I was going to lump sum invest into a stock, I would like to see it at least at its 4-year average, if not higher. So if you have money on the side and you're looking to lump sum, that's a great way to start, is looking at their 4-year average, compare it to where it's currently yielding. But here's another cool thing is, let's take a look at the yield on cost. The yield on cost is what you are getting paid as a shareholder relative to the amount that when you bought into it. So let's say you bought into Pepsi 5 years ago, and let's say you invested $1,000. 5 years ago, that $1,000, you're yielding over 4%. And that is really good. And that's what we talk about is, the miracle of compounding is your investment, as long as the business is growing, they're growing their revenue, they're growing their earnings. This is what you want to see as a long-term dividend investor. Now let's go back 10 years. If we go back 10 years, if you would have invested $1,000 10 years ago, you'd be getting 6.5% dividend yield on that initial $1,000. And now let's just take a look for fun here. If you were to, bring this out to 20 years or 30 years, if you invested $1,000 20 years ago, you're yielding just under 9%. And 30 years ago, you're yielding over 25%. Pretty cool if you ask me, right? So when you look at this, okay, if you buy into Pepsi today, you're getting a measly 2.5%. But over the long term, as the business grows and as the business increases its dividend, it's rewarding you as a shareholder. Okay, so that's the very first thing that I'm looking for, when I'm looking at the dividend yield. Then what I want to look at is how quickly is Pepsi growing its dividend? So if I put in $1,000 today or yesterday or last year, how quickly can I expect, or how fast is that yield going to grow? And when we look at the CAGR stands for compounding annual growth rate of just the dividend. This is important. It's not the share price. It's just the dividend. And so over the last 3 years, Pepsi has grown its dividend just under 6%. Over the last 5 years, compounded annually, 7.5%. And over the last 10 years, annually, it's averaged just over 7.5%. So this is pretty good. I mean, 7% is a good amount. That's why I personally would like to wait to see a entry point. If you're going to lump sum invest into Pepsi, an entry point right around 3%, given its historical data and where it's traded. But if you're dollar cost averaging, every day is a good day, right? You're buying high, you're buying low. That's just how it works as you dollar cost average into the portfolio. Okay. Also, so When you're using Seeking Alpha, you got different features here. You got the dividend safety. The dividend safety is generally focused on a couple of things. It's focused on the debt that the company owns. So, that they have their liability, right? What do they have to pay back? So that's one piece of it. The second is the payout ratio. The payout ratio is really the truest form, in my opinion, when it comes to the dividend safety. The payout ratio is the net amount that the company is paying out to shareholders, from their net earnings, right? So if they have a high payout ratio, in most cases, that means that they're not going to be able to increase their dividend. And that's why you're generally going to see like a company like Microsoft or Apple is going to have a low payout ratio because it's more growth oriented, or a Costco, for example, and a Target. Whereas a utility like Southern Company or, a Sin stock is going to have a higher payout ratio. And in some cases, that's actually quite normal. In a utility, it's very normal to have a higher payout ratio, but with a growth stock, you generally want to see a lower payout ratio because you want to see them reinvesting into their business, okay? And so when I'm using Seeking Alpha, I'm looking at the payout ratio. The payout ratio of Pepsi right now is pretty high. This is actually really high. I would like to see this in the 70s or, maybe even in the 60s. But Coca-Cola trades right around that 80% as well. I personally would like to see it a little bit lower. Across the board, for most sectors, I think a safe or a healthy payout ratio is right around that 40 to 50%. If you're in an established business, 40 to 50% is really ideal. But once again, it depends on the industry. Growth stocks, you want a low payout ratio. Utility stocks, it's okay. It can be a little bit higher. And really just, I guess, an easy way of looking at this, consumer staples versus consumer discretionary. Consumer staples, it's okay to have a higher payout ratio, which Pepsi is, but a consumer discretionary, you want to see a lower payout ratio. All right, now let's take a look at the dividend history. Dividend history, here you got two things here. You got consecutive years of dividend growth and consecutive years of dividend payments. These are two different things. This means the company has paid a dividend. This means the company has increased its dividend. So when we think about dividend growth, this is the section right here that we want to focus on. This is what is important to us, okay? So when we look at this, when we look at the history, we can see, oh, wow, that is like a perfect 10 out of 10. This is beautiful. This is great, right? So this is what you want to see. And here, this is interesting. You can see what you're getting paid on a quarterly basis, and you can see when the company generally increases their dividend. So you can see Pepsi here generally increases their dividend for the year in Q2, which will be paid generally here in end of June, July, right? And so that's how that works. And another thing that you want to be aware of is the frequency. How frequent is the company paying its dividend? Most blue chip companies pay a dividend quarterly, right? So you're getting it paid every 3 months. There's a few businesses out there like a realty income or a real estate investment trust or ETFs that pay it on a monthly basis. And in some cases, you have an ETF or a business that pays it biannually or annually. So twice a year or once a year. And so you want to be very careful, right? There's some investments out there that, they only pay once or twice a year, and that is maybe not what you want if you want to rely on the dividend income and that's your sole source of income. Okay, really, really important. Now let's take a look at some of the financials. Okay, so if we go over the financials, if you're using Seeking Alpha, you can go over here. What I like to start with is go to financials and then go to overview, and you can see a snapshot over the most important data that you would need. This would be kind of your executive summary of investing into a company like Pepsi. So you're going to get, really at a high level, all the important information that you're going to need to know. Okay, you're going to see the market cap. You're going to see the PE ratio. The PE ratio is the price to earning, right? So how expensive the company trades. Companies like Pepsi and Coca-Cola, they just generally they trade at a higher PE. It's just how it is. Generally, dividend aristocrats, they will trade at a higher PE ratio. So when you see them correct, when you see them go down, it's usually not always, it's usually a good time to average down if you're dollar cost averaging. Keep that in mind. The dividend aristocrats are really, really sought after, and it drives up the PE ratio. But a couple of things that I want to take a look at. So I want to look at, this is really one of the main things that I look for when I'm looking forward looking. Is this company growing? And if the company is not growing, how are they going to grow their dividend? How are they going to increase their dividend if they're not increasing their revenue and they're not increasing their earnings, right? You think about it logically. If a company is not growing, how are they going to continue to pay more? And quite honestly, it's the reversal. If they're not growing, they're shrinking, they're getting smaller, they're going to react accordingly, and they're either going to cut or suspend their dividend, both of which are not ideal for you if you're living or planning on living off the dividend income in retirement, right? You think about it, really important. Just think about it with your day job, right? Imagine your employer said, okay, Johnny, you're working 40 hours a week this month. Next month, we're only going to have you work 15 hours. And then you're like, well, I need 40 hours to pay for my living expenses. And then Bob, your boss, is like, SOL, Johnny, you only get 15 hours, right? And so it's kind of the same concept. You want to make sure that the company is thriving and growing, right? And so what I'm looking at is, what is their revenue growth? If they're not growing their revenue and they're not gaining market share, it's going to be difficult for the company to continue to grow and reward me as a shareholder in the form of a growing dividend, right? And so this is something I'm really focused on, is the dividend, the revenue growth. And so another thing that I'm looking at here, this is going back into the risk factor. You have your short-term and you have your long-term debt. Short-term debt is what they're obligated to pay within the next 12 months. So it's a short-term liability. A long-term liability is longer than 12 months. And so what I'm looking at is, okay, they have a short-term obligation of just around $4 billion. What do they have in free cash flow? What do they have in net operating cash flow? So these are the things that you want to look at. If you're a dividend investor, you don't want to just come and look at the dividends tab and say, oh, this company's grown its dividend for 30 plus years. It's a great investment. And then you realize you just invested into AT&T, and then you just realize that the management sucks, and then they are selling off their Warner business, and you just realize that you're going to be getting a 50% dividend cut, right? Sorry for the rant there, but that's the reality, right? And so all of these things, you have to kind of understand that it's not just looking at, okay, what has the company done historically, but can they maintain that? And if they're able to they're only able to maintain it if they're growing, and they have to grow their top and bottom line. So what does that mean? Top line is their revenue. Are they growing their revenue year over year, right? And so you can see 2016, they've grown their revenue year over year. They are growing their top line. And then what you want to look at is you want to see, okay, well, what are they keeping? What are they, of what they're growing? Is it costing them more to acquire more customers? Is it costing them more? Or are they also growing their bottom line, their net revenue, or the net income, excuse me. And so you can see that, there's a little bit of fluctuation here. And so you can't necessarily take this at face value always, because it's possible that they had an acquisition, right? They may have acquired another company, right? And so they may have done that in the form of a cash buyout, or a share, through some kind of, gymnastic acquisition where they use shares as well as cash. So you have to really look at this at a high level. And if you're really concerned, you can dive in and read their quarterly or their annual reviews, their 10Ks, their 10Qs, etc. But for the normal investor that maybe is not so inclined or doesn't really understand that, you want to make sure that the company is growing their revenue and they're growing their earnings. Their earnings per share is growing year over year. Because if you're noticing year over year or quarter over quarter that their earnings and their revenue is going down, that's a red flag. That means that their payout ratio is going to increase. And if their payout increases over 100%, in most cases, there's an imminent dividend cut or dividend suspension. So very, very important. Now let's go back over to dividends here, and I want to take a look at something that's pretty cool. This is something that they added to Seeking Alpha, which is dividend estimates. And what this is, it is Analyst consensus dividend estimates. And you can see the number of analysts that are tracking Pepsi, and you can see the dividend the dividends per share that analysts are forecasting here over the next couple of years. This is so cool, everybody. Like, honestly, if you've not used this in the past, this is so cool. Go look at your portfolio, look at your favorite stocks, and go over to dividend estimates here on Seeking Alpha and see if they have, analysts covering the stock, and see what analysts are projecting or estimating the dividend increases will be. Really, really cool. So analysts are expecting a dividend payout on a consensus rate. So there's going to be a low and a high because there's 12 analysts covering it. They're not going to all, have the same number, right? So you have a low and you have a high, but the consensus is that for the year of 2022, for every share that you own, you will get paid $4.45. Pretty cool. And if you continue to hold into next year, into 2023, the consensus is $4.70. And then into 2024, the consensus is this, you got to kind of take with a grain of salt because there's only 3 of them, but $4.90. But this is what we want to see. We want to see the growth. In a nutshell, this is how I use Seeking Alpha to research my dividend stocks. I'm looking at the dividend yield. I'm looking at the dividend growth. I'm looking at the dividend safety. I'm looking at the dividend history. I'm looking at the analyst estimates. What are the analysts saying who are covering this company? And then I'm looking obviously at the financials as well. Are they growing their revenue? And all of this is what it means at a high level to research dividend stocks. That's the first level. The next level, if you want to up level your skills and be like a black belt, in dividend research, then you want to go and you want to listen in on the company's earning calls, read their annual reports, their investor presentations. That's how you really, get to that next level. And maybe in a future video, I'll cover that and how I do that. But as a baseline, this is what every dividend investor, if you're going to invest into individual stocks, this is the level of detail that you should be viewing your dividend stocks. Okay, it's a little bit easier with ETFs, but with dividend stocks, this is the level that is a baseline that you should be looking at with your companies. Well, folks, that's everything that I had for this video. I hope that you learned something new. I hope that this was able to help reassure that, it's not really that complicated. There's just a few things that you need to make sure that you're focusing on when looking at researching individual stocks, but this is really a baseline that you should be focused on. As you can see in my portfolio, I am buying. I'm buying into the stock market. I'm dollar cost averaging every single week. The market is down, I'm buying. The market is up, I'm buying. Thank you so much for watching, everyone. I hope you all have a great week, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.